Thank you, Sarah, and good evening, everyone. And it's a great pleasure to present an update on Tharisa this evening to you all. So, as Sarah introduced, we are Tharisa. We're a dual-listed co-producer of platinum group metals and chrome concentrates on the London Stock Exchange and Johannesburg Stock Exchange. We see ourselves as a sustainable business, and really that's premised on the fact that we have one of the world's largest chrome resources at some 859 million tons. Now, that's all good and well, but what does it mean in terms of in situ resources that we mine? So if we were to look at our resource as updated in our latest annual report, that equates to just short of 43 million ounces of platinum group metals and 172 million tons of contained chrome metal. So we're not a new company. We've built a robust business model and in turn have become a leading platinum group metal and chrome co-producer. And this really is unlocked by this large resource that I introduced us with. But the key factor here is that we have a long life, low cost, mechanized open pit mine with 14 years remaining. Thereafter, at least 40 years at the same run rate with the same low cost structure with the mechanized skilled labor force. I think the uniqueness of this project, it's the only co-producer in the Bushveld complex, which is the heart of platinum and chrome of the world, containing some 2/3 of the world's resources. I think the uniqueness of our project is that we've tackled the middle group reef horizons on a co-product basis, which historically have only been exploited for chrome. And to that effect, only 2 of the 5 seams that we mine. So our ethos and our culture is to extract maximum value out of every ton of cube that we mine. To that end, we have a very strong and focused research and development team, and we're very pleased with the number of the initiatives that we've designed and thought up and actually brought into production while operating the Tharisa mine. And those are really to extract more value out of the chrome products, namely in the premium chemical and foundry grade products, as well as our PGM refining and smelting that we intend to unlock more margin that currently we give away to the refiners that we sell to. So if we look at the fundamentals and the core values of our business, safety is at the forefront. And I'm pleased to report and continue reporting that it maintains we maintain a industry-best safety record. At the year end, which is our September year end numbers, we achieved a 0.09 lost time injury frequency rate per 200,000 man hours worked. We also achieved a 5-year fatality-free status at the end of September, and we were awarded a number of achievements by the industry and by the Department of Minerals and Resources. But we don't stop there. We're also passionate about learning and education. And to that end, we have a number of bursaries and scholarships that we provide for the youth and for our employees. But importantly, we also provide an adult education and training service and function, not only to our own employees, but to the communities within which we operate. And this is a free service and education for anyone who wants to attain a matric leavers certification. So where does one position Tharisa in the global demand of both these very special commodity groupings, namely platinum group metals and chrome concentrate? So as at our year end, we produced some 142,000 ounces of PGM, and that was through restrictions and curtailments during the COVID-19 pandemic. This places us as the 6th largest listed South African PGM producer. But in terms of the products that we produce, and we talk about a PRILL split, and that's the breakup of the 6 elements within the platinum group metal composition. So of that 142,000 ounces, we accounted for around about 1.3% of global platinum demand, 0.3% of palladium demand, and very importantly, 2% of the world's rhodium demand. So if we look at that bottom left-hand pie chart, we'll see that our PRILL split, or our split of these 6 elements, is weighted towards platinum at 55.4%, to palladium at 16.2%, and rhodium at 9.6%, and the balance of iridium, ruthenium, and gold at 18.9%, providing a very valuable basket of prices. In terms of chrome, we're a large-scale producer. We're 4th largest in South Africa. We produced just shy of 1.35 million tons of chrome concentrate last year, and this equates to 10% of Chinese chrome imports. So a significant player and feedstock supplier into that very large stainless steel and buoyant and thriving industry. 1/4 of our production is specifically and specially focused on producing these premium quality products, which are diversified globally as well as from the stainless steel market, and those being specialty, chemical grade, and foundry grade products. We are one of the world's largest chemical grade producers through our specialty product production. In terms of our 2020 highlights, and again, this was through a disrupted cycle of the COVID-19 disruptions in South Africa, we were very pleased with our performance, where we mined just shy of 5 million tons, up 7.6% year on year, and as mentioned on the previous slide, producing 142,000 ounces and 1.34 million tons of chrome. This resulting in revenue of just over $400 million, an EBITDA of $113.4 million, earnings per share of 16.2 cents, and a big boost from the prior year, yielding a return on invested capital of 18.8%. And pleased to report that that is growing in the buoyant pricing environment. And as Sarah mentioned, we've just authorized and approved the final year dividend of 3.5 US cents. I think I just want to pause here for a moment and reflect on the pricing environment. So for our financial year 2020, which ended in September, the average chrome concentrate price was $140 per ton, and the average platinum group metals basket price was $1,704 per ounce. Now, the world has changed, and we are certainly in a bull cycle, and chrome prices have recovered nicely to $165 per ton. But the real star of the show is the PGM basket price at some $3,500 per ounce. So that's a doubling of the average price from the prior year. So if we were to look at the pink bar chart just below the production numbers and look at our guidance for 2021, which is 160,000 ounces of PGMs and 1.5 million tons, it doesn't take too much clever mathematics to figure out that just on a revenue basis, we should be at least 50% higher on the same cost-based structure. So increasing margins, very buoyant pricing environment. Importantly, our Q1 production was on target and is on target for us to meet our guidance for financial year 2021. But very importantly and significantly, we managed to negotiate a 4-year wage agreement with the unions on site. And this most probably is the longest agreement in the industry at the moment. Typically, these are 3-year agreements. So very pleased with the constructive relationship that we have with the unions on site and the ability to share in the upside of the Tharisa business case. So if we were to look at the quarter on quarter, up 14.2% in terms of PGM production, just shy of 40,000 ounces at 39.3 thousand ounces, compared to 34.4 thousand the prior quarter. Similarly, in terms of chrome concentrate, up 8.7% at some 372,000 tons compared to 342,000 tons the prior year. I think this really talks to the sustainability and the ability to deliver into those guidance numbers. At the end of the quarter, our cash sat at $49.8 million, with total debt reduced from almost $70 million the quarter prior to some $45 million, leaving us in a net cash positive position of $4.8 million. So just if we pause on this slide for a moment, we're really proud of the fact that we've built this sustainable business model. And it's not just now that we have very buoyant and lofty prices that we're a profitable, sustainable business. We have been unlocking the value of a co-product business since inception and have been generating cash ever since. Now, it does fluctuate and the margins will vary, bearing in mind the macro commodity prices. But the fact that we're a rand-denominated cost structure with a US dollar-denominated exit price gives us a very nice hedge in terms of those offshore prices and domestic prices in a weakening South African rand environment. Very healthy cash generation, and we'll touch on some of those metrics a bit later. But importantly, throughout the cycle, we've continued to invest in safety, health, and environment, in people. We brought on board the owner mining business model, invested heavily in yellow mining fleet. We have growth projects, the Vulcan, the Challenger plant, and all of these unlocking value and recovery of these metals that we mine through the open pit. Our balance sheet has been robust. We've brought debt onto the books, we've repaid it, we've refinanced new opportunities and growth projects, and today we sit again in a net cash positive position. Importantly, our liquidity management has been very good. We continue to remain a consistent dividend payer, and we're cautious with our investments. Our hurdle rates are very, very stringent and very strictly adhered to. But importantly, our return on invested capital is growing as we speak. So I mentioned we're committed to dividends. We've been paying dividends for the last 5 years and slightly above our stated policy of 15% of net profit after tax to be distributed to shareholders in the form of a dividend. Very pleased that we could continue that tradition, and no doubt in the current pricing environment, we will continue with that capital discipline and really returning value to shareholders while still affording growth within the business. So how does one position Tharisa in a portfolio, an investment portfolio, or just compared to our peers? So if we look at that PRILL split, that split of our four most valuable elements on a PGM basket basis, so that would be rhodium, platinum, palladium, and gold. You will see that in terms of our PRILL split, we rank as one of the highest value propositions. And this really is due to the fact that we have that 12% rhodium. And if you've been following the rhodium price, it has breached $21,000 per ounce. So at spot prices at the time of this Investec publication, our PGM basket price on a 4E basis was just shy of just over $3,600 per ounce. And you can see all the major PGM peers that we compared to, as well as, and these are all miners, by the way, with resources that actually mine platinum group metals. And then you can see the long-term real pricing there, and that's on consensus, which in our view is still quite conservative, bearing in mind the following slides that we'll touch on. So if we look at the consensus, or this is a broker forecast from RenCap, you'll note that our free cash flow yield is set to grow over the next 3 years considerably and exponentially. And this is what we really want to leave you with today, is that we have been profitable and cash generative through the difficult pricing environments. And if we look at this bar chart, the EBITDA margin chart on the right-hand side, you will note that in the years 2010 to 2020, bearing in mind that we've only been listed and tracked since 2014, our EBITDA margin ranked higher than the rest of the PGM peers. And this really is due to that co-product nature. While in the current environment and looking at the spot EBITDA, we are slightly lower, slightly ahead of Royal Bafokeng Platinum and behind the four majors in the middle. And the main reason there for that is that they all have their own refining capacity. So we sell our PGM concentrates currently to Impala Platinum and Sibanye, whereby they get the kicker or that additional margin. So through our R&D team, it is our intention within the next couple of years to capture that additional margin through our own beneficiation facilities. Again, looking at Peel Hunt and RenCap valuations, potential share price upside at current spot prices, you'll see we're very nicely placed there at a potential upside of 157%. But importantly, year from 2020 to 2021, the earnings growth capacity of Tharisa is really illustrated by that 234% that is being forecast. Again, a favorite metric, EV over EBITDA, you'll see if you compare us to the South African PGM producers and the other listed miners on average, and that's forward-looking again for 2021 and 2022 estimates, we still look extremely undervalued and very cheap at this point in time. So if we just touch on our commodities, and I'm cognizant of time, this graph on the left-hand side talks about the structural deficit and the supply side constraints within the platinum group metals supply side and demand cycle. And really what this tells us is that for the next 10 years, platinum and rhodium in particular are going to be in an increasing deficit position. Now, one must understand that this excludes investment demand. So all your ETFs, your coin and bar collection, and that has accounted for a significant amount of platinum demand in 2020 and is forecast to continue into 2021. So one needs to look at that in this context. This comes from BASF, the largest auto catalyst producer. I think what's important here is that the supply side response to this increasing demand and constrained supply is very timely and very capital intensive. And through the difficult times, there was very little investment in one, replacement capacity, and also new PGM mines. Now, we know of a few that are in the pipeline, but it takes a number of years and some billions of rands to get those into production. And really the big takeaway here is the sustainability of these higher PGM basket prices. And in the medium term, we certainly feel confident that we should be seeing a high PGM basket price. Now, on the other hand, chrome is an essential element in the stainless steel making process. It is irreplaceable. South Africa is a concentrated supplier, supplying more than 80% of the chrome needs globally. And this phenomenon is really driven by the Chinese demand and particularly domestic consumption of stainless steel within the Chinese economy. And we're seeing that industry growing year on year. And even in spite of COVID, we saw a remarkable growth in China of some 2 million tons capacity in the financial year or calendar year 2020. In terms of rhodium, again, I'm not going to spend too much time on the slide. It's an update from the previous one, but really reinforcing the fact that the increasing emission standards to reduce nitrogen oxides or nitrous oxides from the atmosphere have really precipitated a big boost in demand. And with supply being constrained from primary sources, and this is really as a South Africa-centric story, with 80% of the primary supply coming from South Africa, we can only forecast a growing deficit and literally physical supply constraints and limited liquidity in terms of being able to fulfill and meet demand. The big question is substitution. Very difficult to replace rhodium and substitute it. You can put 4 or 5 times the amount of platinum or palladium in, but it requires a lot of engineering, a lot of time. And based on the response and the reaction of the Dieselgate scandal, the OEMs are not very keen to look at thrifting. Again, a repeat on the previous presentation, palladium really, the demand is driven by the gasoline internal combustion engine, with almost 86% of the demand coming from palladium. And this is a Russia, South Africa, Canadian story, and this is still forecast to be in deficit going into a surplus. Platinum, on the other hand, is quite diversified, with 32% going into AutoCAT, similar number to industrial, and the rest into investment and jewelry. Chrome, again, so we're a key supplier prices are moving in the right direction, and we're comfortable with where we sit in terms of the demand cycle. So in terms of Tharisa and our 6-pillar growth strategy, we're focused on expanding and rolling out our business sustainably, and I think we've achieved that successfully. We're looking at optimizing and extracting more value out of existing operations, be it through the Vulcan process, which will add an extra 25% chrome production to our bottom line, taking us to 2 million tons of chrome concentrate. And that project is under construction as we speak, and that is an innovation that was developed in-house. And the key focus remains to become a globally significant and diversified business, becoming the investment of choice, and importantly, enriching the lives of all our stakeholders responsibly. It was a very rushed presentation. I apologize. There's lots of information there. Hopefully we can capture some of the questions and answers.
Flower, please don't apologise at all. I've been interviewing you since 2014, and that has to be the best presentation I've ever heard in terms of metrics and size and scope. And I just hope that you can maintain this, because it looks as though we've got a virtual room full of accountants from some of the very technical numerical questions that are being populated in the chat room. But there's one came from Twitter earlier on today to my own account, and Share Money asks whether there is a seller suppressing the price, and would you consider a share buyback program with your increasing cash position to clear the overhang?
So a very good question. We have been seeing a lot more liquidity in London, and a lot of buying and selling for that matter, which is great from our perspective, because one of the prior criticisms was a lack of liquidity and flow of stock. So great to see that on the one hand. In terms of the share buyback, in terms of an overhang, it's something that we have touched on as a board and an executive, but we think we can create a lot more value with what we're doing, and through the initiatives that we have, and in turn also return some of that cash to our shareholders. But it's something we haven't ruled out, and perhaps as we consider our half-year results, it's something that we may review closer.
Okay there. Well, you spent a lot of time within your presentation talking about what you are able to control. Congratulations on that 4-year wage agreement. It's something that we in the UK certainly couldn't agree upon. But Nigel asks, Thea, what are your most significant variable costs, and to what extent are you able to control them?
Yeah, so it's a good question. So if you look at the split of fixed versus variable costs, it's most probably around 70 fixed costs, 30% variable. And really that talks to the diesel consumption, which is on mine cash costs now I'm talking about. So diesel consumption, electricity, water, utilities, that most probably accounts for just shy of 30%, and those would be your variable costs that you can turn on and off if you're not producing. But generally speaking, because we run our own mining fleet now, and we do have that capital and the employment of some 1,500 people, a large portion is fixed. Again, then we'd look on a holistic basis beyond the mine, your logistics cost would come out, and half of that 100, or I'd say $60 of the $165 CIF price is a logistics price. So that would obviously not be incurred if we're not exporting.
And a supplementary question from the same author, who asks, to what extent is the company economically exposed to one or a few purchases? And then they go on and say, would the loss of any single customer prove to be a serious threat?
So we're pleased that we have a very diversified and broad customer base, and we have many takers for these valuable commodities. So from a customer perspective, I think we're well diversified, and we have many channels. If we look at the bulk side of the business, the chrome side, we have many users and many channels to market, and some may even be intermediaries, being domestic ferrochrome producers, domestic chemical foundries, etc. And then we look broader beyond into the export market. On the PGM side, it does seem that we're quite concentrated to 2 refiners, but during the lockdown last year, during COVID-19, we were able to divert those ounces from one to the other and vice versa, and open up other channels to distribute that. From a supply side, I think, we're a well-established mining industry. There are many suppliers, many OEM suppliers on the yellow mining fleet. So I don't think we have any concentrated risk on the supply side and on the customer side.
Now, your chairman, who I think is a family member, is known for having his glass always half full. He's very optimistic. So it was a surprise in the most recent investor update where he said, disappointingly, the South African government has not made any further public comments on the proposed export tax for chrome. Obviously, this is like a monkey on your back, if you forgive that analogy. I mean, what is in it for the government, and how would an export tax impact you?
Yeah, so I mean, I think we've been quite vocal, and as part of the Chrome SA grouping, which is a grouping of some PGM byproduct producers and primary producers, we really believe it's a blunt instrument, and it will not provide the relief that the government thinks it will to the then ailing ferrochrome industry. In today's current pricing environment, all industries are making a decent margin, and in some cases very good margins, particularly in the ferrochrome industry. So the initiative, I think, was born out of an idea that they needed to intervene and assist a struggling part of the value chain. But really, if we look at the primary reasons for that, it's due to a sort of fivefold increase, of electricity prices over the last 10 years, as well as a lack of investment in technology to compete with the voracious investment in technology in ferrochrome and stainless steel within the Chinese economy. So those two have really made South Africa marginal for the most part. There are some cost-effective processing units. And so the government was trying to support that part of the value chain. And bear in mind that this is not a new initiative. It's been around since the mid-2000s, and on two previous attempts, it was parked and not approved. And much to our surprise, to be honest, did we hear about this proposed approval of a tax. Now, I think the reality is that the mechanics and the ability for government to introduce it are quite complex and potentially could breach a number of international trade laws. So I think, once it's the monkey's out the cage, as you've said, but now it's unpacking it. How does this fold out? And I think we're on a very good footing, or strong footing, as Chrome SA, to defend our position, because really what you're doing is you're prejudicing one part of the value chain to support another part, and by no fault of either. Really macro factors playing into that. So we still remain positive that logic will prevail, and the right course of action will be taken. However, again, what impact will it have on our business? Metallurgical chrome, which is really the target of the tax, accounted for some 20% of our earnings in the last financial year. So significant, but not major. And the idea is that we wouldn't bear the full brunt of that tax. We would pass it on to the end user, but not an ideal situation. And really what we're looking for is clarity from the South African government. Either way.
Well, certain people on the virtual floor are looking for clarification. We've already discussed dividends and potential share buybacks. You're going to discuss that with the board. Afan is very excited, and he says, how and when can you see Tharisa producing 200,000 PGM ounces per annum?
Yeah, so we did set out a Vision 2020, which had the 2 million tons, which we're well on track to achieve with the commissioning of the Vulcan plant, and the 200,000 ounces. So you will notice that, or you would have noticed that our guidance for this financial year is still at 160,000 ounces. And the idea, or the target for us, is within the next 24 months to achieve that 200,000 ounce target. We're being a bit reticent about it and conservative on the back of the fact that we are mining more volume, and we need to focus on that head grade going into the processing plant. The recoveries are returning back to their normal levels, which is very pleasing, and the processing plants are able to handle higher throughput. So the combination of those three should see us getting to that 200,000 mark within the next 24 months.
We have run out of time, unfortunately, but for those of you on the Webinar Jam platform, Ilya Graulik has welcomed emails from you. She belongs to the company, so it's igraulik@tharisa.com, and she says, for those questions that we have not been able to answer, please feel free to email me. So if you go to the top of the chat box, you will see a very precious email there. One final question from me to you. In terms of the characters on that final page there, which one are you?
Fortunately, I'm none of them. But yeah, so this is a campaign that was developed on the mind by the employees, and each one of them is a superhero to highlight a behavioral pattern. So a really nice initiative that we thought we'd share with the audience. Yeah, so part of our campaign.
Yeah, you're being modest. I think that there's a little part of you, little part of your DNA within all of those characters. It's been an absolute pleasure. Thank you very much indeed. What a difference the share price has been since we last spoke in October. Obviously, I think it's because of my presentations. There you go. Indeed. Thank you very much. Take care,
Thank you, Sarah.
Thank you. You're more than welcome.